if they stuck with you, especially during these volatile downsides, there's so much upside that comes from that. Isn't that right?
Yes. Yeah. The focus is on that long term, and we use these volatile moments as opportunity. Hi, I'm Dan White, Client Portfolio Specialist with ARK Invest. On this season of The Switch, we're going to address how innovation performs in times of market turmoil. As always, we will be joined by ETF Trends to facilitate the discussion and make sure we don't leave anything unanswered. So let's continue the conversation by looking at some real-world evidence of ARK's performance during expansion and contraction periods.
Hey, Dan, great seeing you. And I know you work with tons of advisors and you're talking to investors all the time about ARK ETFs and how they fit in client portfolios. How do you frame that analysis regarding construction of the portfolio and the scorecard?
Yeah, so when we speak with investors and advisors, the real critical message we want to convey in these meetings is to focus on the long term. Keep an eye on that finish line. The middle ground is going to be volatile. We've never shied away from that. And in fact, we think volatility is an opportunity, as you've heard in the previous episodes on this season. But to explain how we're managing through that volatility with these advisors, there were many different roads that we could have gone down, each with different levels of complexity. And in the spirit of explaining our portfolio management process in the most transparent way possible, avoiding complexity, we wanted to keep it real simple. So the way we like to think about it is you can look at our performance really in two categories and watch how we manage throughout that. One being expansion, two being contraction. And the way you can kind of define contraction, think of it as a drawdown of 10% or more from a peak to trough, and expansion being from that trough to the next following peak.
So, that's a classic way of thinking about sort of the ebb and flow of what we see in the marketplace. But we should probably just put up a chart and show this. But if you look over the last couple of years, we've gone from what seemed like slightly longer cycles to tighter and tighter and tighter cycles, right? That's the nature of volatility, right? We've compressed time, but we still have price movements happening at the same velocity they always have. How do you think about that? Because it feels like the nature of time has shifted, and you guys, as you pointed out, are long-term investors.
Yeah, it's a great question. We think that these sort of micro expansions and contractions that you may be seeing, some added volatility in the market, we believe that's a result of the market recognizing innovation and that it is beginning to disrupt these legacy businesses. And as that disruption occurs and evolves, there's going to be tons of confusion, even some disbelief. So we believe that volatility, it will remain over the long term. And that's why it's so important to focus again on that finish line.
Dan, let's talk about the good times. When the market's going up, we're expanding. How do you work with advisors and how do you guide them during those periods of time? Because it can get emotional. People get really excited.
Yeah. So the way that we help them kind of understand what we're doing from a portfolio standpoint is we like to explain that we're going to be broadening and diversifying our holdings in that up market to kind of prepare the portfolio for any sudden bumps that may come down the road, like a correction. So the way we're doing this is we're taking profits from our winners, we're reallocating that capital across other holdings in the portfolio, and then we're adding new names in. And these new names in, they tend to be these larger, more liquid securities that are innovative companies, but they're not pure play innovation. And this is important again when it comes to sort of that flip side. So during the expansion, the way you can kind of think of it is broaden, diversify, increase holdings. And then what we're doing with that, the weighting that we are reallocating, you'll see a lot of it come from the winners, our top 10. Those are our highest conviction names. So we'll be decreasing those weights to spread it across the portfolio.
Let's talk about the downside there, because I think some investors have been surprised to see how much trimming that goes on in the ARK portfolios. You guys put out that trade blotter every single day. It shows up in my email address. And there is a sort of a constant back and forth that's going on here. So what happens when we have rolled over and we're down 11% from that last peak? What would we expect to see in the portfolios?
Yeah, great question. So during that rollover in the contractionary times, what you're going to see is ARK consolidate and contract. So kind of the exact opposite here is what we did on the way up. And we're going to go into our highest conviction, pure play names, those, oftentimes funding those purchases by selling those larger liquid purchases that I touched on during the expansionary part. So during that contraction, you can think you're going to see more names exiting the portfolio, the new names entering the portfolio, sort of consolidating there. And then we're going to be increasing our weight in that top 10 holdings. We build these portfolios from the bottom up, conviction weight approach. So those top 10 are our highest conviction names. And you'll see capital concentrate there.
And traditionally, Dan, on the downside, advisors and active managers aren't always performing well. They tend to benchmark hug, even at some point in time, increase cash positions. But how does all that weigh into portfolio allocation, especially sticking to the long term? Because during those times, you're finding some pretty good bargains, aren't you?
Yes, yeah, it's a great observation. So during these times of correction, we believe active management is absolutely critical. The worst thing you can do is sort of sit there and do nothing. These are the moments where thoughtful and differentiated management can really enhance your long-term returns, in our opinion. Like you said, most of these traditional managers, they adopt some form of short-term risk management. And that may be running back to their benchmarks. And in doing that, they oftentimes are selling these off benchmarks holdings. And a lot of those end up being these very pure play disruptive companies that ARK is so focused on. So during those times, we tend to be selling back to them those larger benchmark liquid holdings as we're buying the ones that they're kind of indiscriminately selling.
Yeah, I mean, in an interesting way, you sort of end up being that counter Wall Street trader, right? You're the one who has the stuff everybody wants to buy when you're ready to sell it. And that really does help create some correlation benefits, right?
Yes, we like to think of ourselves as liquidity providers.
So, Dan, maybe you should send out, rescue dogs or farm animals to calm these people down during these emotional times, because if they stuck with you, especially during these volatile downsides, there's so much upside that comes from that. Isn't that right?
Yes. Yeah. The focus is on that long term, and we use these volatile moments as opportunity.
Well, Dan, it's great to hear how a firm like yours is really trying to do the best of both worlds, right? Really be there during those expansion periods and really make some interesting moves when things are going the other direction.
Yes, thank you for observing that, and thank you for a great conversation. Look forward to speaking with you in the next episode.